Ladies and gentlemen, we have just witnessed a watershed moment in the history of financial technology. For the first time, one chamber of the United States Congress has passed a comprehensive regulatory framework specifically designed for digital assets. On Wednesday, the U.S. House of Representatives voted to pass the Financial Innovation and Technology for the 21st Century Act, commonly known as FIT 21. The final tally was a stunning 279 to 136. This wasn't just a party line vote. It was a resounding bipartisan statement that the status quo of regulation by enforcement is no longer tenable. In a shock to many political analysts, 71 Democrats crossed the aisle to vote yes alongside their Republican colleagues, defying the strong opposition from the ranking member of the Financial Services Committee, Maxine Waters, and arguably signaling a major shift in the political calculus surrounding cryptocurrency in Washington. So, what exactly is in this bill, and why is the crypto industry celebrating this as a massive victory? At its core, FIT 21 seeks to solve the most persistent headache in the American crypto industry, the jurisdictional turf war between the Securities and Exchange Commission, SEC, and the Commodity Futures Trading Commission, CFTC. For years, SEC Chair Gary Gensler has maintained that the vast majority of crypto assets are securities, subject to strict registration laws that were written in the 1930s. The industry has argued that these laws simply do not fit decentralized networks. FIT 21 creates a specific test to determine whether an asset is a security or a commodity. The magic word here is decentralization. Under the Act, if a blockchain network is functional and decentralized, the asset associated with it is treated as a digital commodity under the jurisdiction of the CFTC. If the network is not yet decentralized, meaning it is still controlled by a central entity or foundation, it remains under the SEC's purview.
This distinction is critical. The bill defines a blockchain as decentralized if, among other things, no single person or entity has the unilateral authority to control the blockchain or its usage, and no issuer or affiliated person owns more than 20% of the digital assets outstanding supply. This provides a clear pathway for projects to start as securities while they are being built and funded, and then transition to commodities once the network is sufficiently autonomous. This is the safe harbor and pathway to compliance that the industry has been begging for. For the CFTC, this bill grants new jurisdiction over digital commodity spot markets, authority they currently lack. For the SEC, it retains their authority over initial fundraising and centralized projects, but significantly curbs their ability to classify established cryptocurrencies as securities purely based on the Howey test.
Let's talk about the political implications because they are fascinating. The vote exposed a deep fracture within the Democratic Party regarding financial innovation. Former House Speaker Nancy Pelosi voted in favor of the bill, a move that provides significant cover for other Democrats. This revolt comes despite a statement from the White House earlier in the day. President Biden's administration released a policy statement expressing opposition to the bill, citing that it lacks sufficient consumer protections. But notably, they stopped short of threatening a veto. This nuance is crucial. It suggests that while the administration is not ready to champion crypto, they are realizing that being openly hostile to the industry carries political risk, especially in an election year where millions of Americans own digital assets.
However, we must temper this excitement with reality. Passing the House is only half the battle, and arguably the easier half. The bill now heads to the Senate, which has historically been a graveyard for crypto legislation. Senate Banking Committee Chairman Sherrod Brown has been a vocal skeptic of the industry, and there is currently no companion bill in the Senate. The legislative calendar is tight, and the appetite to move this quickly in the upper chamber is uncertain. Yet, the overwhelming margin of victory in the House puts immense pressure on the Senate to act. It signals that there is broad consensus that the current regulatory void is dangerous for consumers and stifling for American innovation. Even if FIT 21 doesn't become law this year, the framework it establishes, specifically the definition of decentralization and the split jurisdiction between the SEC and CFTC, will likely serve as the blueprint for all future legislation. The conversation has shifted from should we ban crypto to how do we regulate it responsibly, and that in itself is a victory.
So, what is the verdict for 2026? PwC's outlook is cautiously optimistic, but undeniably stern. They predict that by 2026, the cost of compliance will be one of the largest line items for any crypto business. This will likely lead to consolidation.
However, the flip side is legitimacy. With these frameworks in place, the massive institutional capital that has been sitting on the sidelines will finally have the regulatory clarity they need to enter the market at scale. In conclusion, the PwC report is a wake-up call. The infrastructure is being built, the laws are being written, and the deadline is approaching. 2026 will not look like 2024. As investors, we need to be aware that the market dynamics are shifting from retail-driven hype to regulatory-driven utility. Make sure you are subscribed so you don't miss our deep dive into the specific impacts on DeFi next week. Thanks for watching. But what does this mean for the price of Bitcoin going forward? We have to look at supply and demand 101. The supply of Bitcoin on exchanges is reaching multi-year lows. Long-term holders are refusing to sell. ETFs are sucking up coins faster than miners can create them. And now you have corporate entities like MicroStrategy acting as a black hole for available supply.
Critics, of course, have been vocal. They argue that Michael Saylor is concentrating too much risk in one asset. While technically true, this argument ignores a fundamental value proposition of the network. Bitcoin has survived bans by China and the collapse of FTX. Saylor's bet is that Bitcoin is not going to zero. It is going to infinity against the dollar.
Furthermore, this strategy has created a copycat effect. We are seeing other companies and nation-states begin to adopt the Bitcoin standard. The 712,000 BTC figure is a beacon to other treasurers and CFOs. It signals that it is safe to enter the water. It normalizes the idea of Bitcoin on the balance sheet.
Let's discuss the psychological aspect of this holding. 712,000 Bitcoin creates a fortress balance sheet. In a world of geopolitical uncertainty, having a bearer asset that is unseizable and liquid is the ultimate insurance policy. Saylor often refers to Bitcoin as digital energy. By storing the kinetic energy of his company's cash flows into Bitcoin, he is preserving that energy for the future.
So, what is the bear case? The risks primarily lie in regulatory crackdowns or a catastrophic failure of the Bitcoin protocol, events that are becoming statistically less likely as adoption grows. The more integrated Bitcoin becomes with the traditional financial system through ETFs and banking integration, the harder it becomes to ban. It has crossed the chasm.
Looking ahead, where does this go? Saylor has predicted Bitcoin prices in the millions per coin. If Bitcoin captures the gold market cap, we are looking at $500,000 to $800,000 per coin. The addition of these 2,932 coins is a massive signal of confidence in this future valuation. It tells the market, we are not done yet. For the retail investor watching this, the lesson is clear. You don't need to be a corporation to adopt this strategy. The principles of dollar cost averaging, holding your own keys, and having a low time preference apply to everyone. Saylor's aggressive moves act as a validation for the little guy who has been stacking sats for years. As we wrap up this analysis, consider the timeline. We are still early in the adoption curve. Most pension funds and sovereign wealth funds have zero exposure. As they move from 0% to 1%, the demand shock will be colossal. Michael Saylor is positioning his strategy to front-run this wall of money.